Hello, everyone. My name is Matt Cincerello, and I'm the owner and managing partner here at U-Nique Accounting. You can learn more about what we do by visiting us at our website, u-niqueaccounting.com. Also, today is Friday, so cheers. Happy Friday. Also, if you're wondering what I'm drinking, today's beverage of choice is Cutwater Margarita. We need a little drink on a Friday. It's these small little cans. And if you notice that my cup is bearing the hashtag Make Today Count, this is a slogan for my Best Friends Foundation, which is a close and personal not-for-profit that I'm a board member of. A link will be provided to a form you can fill out if you or someone you know needs help with dealing with the impact of cancer in their life. So let's go ahead and we're going to jump into today's topic. Today's topic is focusing on restaurant-specific tax write-offs. So I don't want to waste your time in this video talking about donations that any business anywhere can deduct. Okay, most of those, you're a business owner, they're very common. What I wanted to address are three specific industry tax issues. And those being, one, the FICA Tip Credit, two, donating food to charity, and three, pre-opening costs for your first location and additional locations. Man, that's good. So the FICA Tip Credit. We have a whole video on this that I recommend you watch. But this credit is only available to businesses in the food and beverage service industry. So if you own or operate a bar or restaurant and you don't file Form 8846, I'm slowing down on purpose. If you don't file Form 8846 with your business tax return, hint, go get your tax return and look for this form, you are not taking advantage of this tax credit, which could be tens of thousands of dollars a year, depending upon how much tips you report. In essence, while I recommend you watch that other video because it goes more in depth, the refund is a refund of all your employer paid contributions of Social Security and Medicare tax on the employee tips that got reported as wages. So if you don't have that form, you're missing out on a lot of money. Number two, stop throwing food away. I get it, food spoils, that's different. But if you are throwing food away because it's getting close to expiration and you don't want to give it to your customers, did you know that your restaurant can benefit from donating it to a charity? So for example, let's say you spend $5 on a piece of beef and you could sell that to your customer for $15. Normally, you would be like,
oh, it cost me $5, I get a $5 donation.
That's not how it works. When it comes to restaurants and grocery stores, you get a step-up basis in that donation. So for example, on that $5 piece of beef that you can sell for $15 to your customer, if you donate it, you can get a deduction for $10. Did you hear that? Not $5, $10. Now there's some math in those calculations. In my example, it is $10, but it does depend upon the markup, and there's two different ways to calculate it. But in essence, you get a step up in the cost to donate it. There's a lot more documentation to go around this write-off, but it's worth it because of the additional deduction you get. And the last one I want to talk about is pre-opening costs. A lot of places do this wrong. Hopefully, when you opened your first bar or restaurant, you or your tax accountant accounted for your pre-opening costs. And these would be the costs to research the place, get it built up, train people, all the payroll costs before you open, food recipes, like anything you had to do to get the restaurant ready before it actually opened and service customers. And what you're supposed to do is you're not supposed to deduct them. The IRS requires that you amortize these over 15 years, right? So most of these costs that get started up running are not deductible and they're slowly written off. However, if you decide to open a second location, as long as you follow common ownership rules that the IRS has, you can immediately deduct these pre-opening costs instead of slowly write them off over 15 years. So if you have multiple locations and you've had the same ownership and you keep seeing writing off over 15 years of these pre-opening costs, that's wrong. You only have to do it one time, and then all your other locations, you can immediately get a tax write-off. So that first location, you felt the cash pinch because you didn't get that deduction. Well, the second location, you will get the benefit of all that money you had to spend before you open. So thank you for listening to our advice on the three specific restaurant industry tax issues. If you appreciate our advice, please remember to like our video and subscribe to our channel for future content. Until then, remember, don't conform, stay unique.